Thank you, Evan, for that lovely introduction. And thank you all for your time and attention to my presentation. My name is Mike. I work for Robeco, which is a Dutch-based asset manager, and we're proud partners of Momentum. Personally, I'm from Taiwan, and I live in Boston at the moment. But I'm at Robeco. My job is the head of alternative alpha research, which deals with advanced technologies and advanced techniques in quantitative investing. In this session, I will talk to you about how machine learning, natural language processing, and all these new fancy terms that you have heard is impacting and affecting quantitative investing. So let's start by setting the context and telling you about evolution of quant investing. Obviously, with the hype around ChatGPT, let's ask a GPT-like model, how are machines affecting quant investing? Let's start from here. So you ask GPT this question, and it will give you some answers, right? And you can read the answer and decide whether you believe it or not. I hope after the end of my talk, you will see the answer that GPT give you is either sensible or not sensible. So let's set the context, right? There's been three trends that's really been transforming human society over the last several decades. And they are data, algorithm, and computing power. First, data. The amount of data that's being generated is just staggering. According to this statistic that is shown here, every day there's 463 exabytes of data being produced. So you might ask, what's an exabyte? Exabyte is 10 to the power 18. So that literally is 1 followed by 18 zeros. So it's a staggering amount of data that's being generated on a daily basis by humans on this earth. And according to some study, the amount of human-generated data now doubles every 2 years. So since the beginning of time until now, we generate a certain amount of data. In the next 2 years, we're going to generate equivalent amount of data, and that's only going to continue going forward. Second thing is the dramatic increase in computing power. The chart I show here is a logarithmic graph. So that means that the scale on the y-axis is not linear. If you put this in a linear scale, this thing grows exponentially. So it just shows you how much the increase in computing power we are now have in our fingertip. If you have a smartwatch on your wrist like I have right here, right? You actually have more computing power on your wrist than what it took the Apollo astronauts to plot the rocket to the moon and back 60 years ago. So just absolutely staggering. And then finally, there are all these really, really powerful computing algorithms that's available, right? So, everybody's heard about AI, and the image you might have is Terminator or some sort of robot that behaving like human. Well, AI is really rather more limited than that at this point in time. Doesn't mean that people are not working towards that vision of AI. They are, but at this point in time, it's rather more limited. At this point in time, AI really falls into two main categories, and I have shown in this chart here. One is ML, called machine learning. That really deals with finding patterns and relationship in a lot of numerical data. And the other branch of AI that's very hot in recent years is called NLP, natural language processing. That deals with reading human text and lately human voice in getting meanings and interpretable sense from them. And you can see that there's a little bit of overlap in the middle between ML and NLP. And this is because the common tools used in ML and NLP in recent years have been the same. A technique called a neural network that you might have heard of. And in the very middle, LLM, large language model, that is the GPT algorithms that everybody is really crazy about in the recent years. So, in addition to the evolution of technology, right, the quantitative investment field has also been changing. So this is kind of how it has changed over the recent years. 50, 60 years ago, anything above a cash deposit return is called alpha, right? So if you just invest in general stock market, more likely than not, you will get what's called alpha because, in the US, for example, the stock market returns 10% on average for the last 100 years, right? Obviously, people figure out that, to get market level return is not so special. So in the 1960s onwards, with the advent of CAPM, the market premia, which is market level return, is now separated from alpha. So anything above market premia, that's still something very special investors are willing to pay for. right? Move the clock forward another 10, 20 years, you have what's now called factor alpha. So these are phenomena in the market that people have discovered, such as value, size, quality, momentum, etc. These factors do deliver long-term alpha, but they're relatively understood. So definition of alpha keeps on evolving. Now, rather than in addition to factor alpha, there's what's called uncorrelated alpha. So alpha that's uncorrelated from what you can get from factor. So this is kind of how the quantitative investment field has been evolving over the last 50 or 60 years. Now, I talked about three things that's really transforming human society, right? These three things have also transformed quantitative investment, and I will talk about them. Specifically, I will talk about data, machine learning, and natural language processing. Let's start with data. Here is a chart of the data landscape in 2012. You can see that it's already very complicated. There are many, many companies in here, right? Here's what that same landscape looks like 10 years later in 2022. You can barely make out any company in this chart. The point is not to hurt your eye, make you squint and see who's what, right? The point is to show you that this data space, ecosystem has just really exploded. You know, it's really, really complicated. It's really, really diverse. There's a lot of company in here. So the question is, as a quant practitioner, how are you supposed to find information in this ocean of data, right? After all, a lot of these data are pretty much noise, right? And finance in general is a very low signal to noise environment. So how are you supposed to find alpha in this noise? Well, the flood of data is really a curse and a blessing, right? The curse is that there's a lot of information in here, most of which are probably useless. Blessing in the sense that if you do have an idea, there might be an data that you can use to validate or to refute your idea. Here's an example. One idea might be that, well, you know, institutional investors, typically their actions are very informative, right? So wouldn't it be cool if we can know which institutional investors are visiting which company to see that which companies are being paid attention to by investors? Well, in the Chinese market, in their regulatory reform 2 decades ago, they institute that all institutional investor visits must be disclosed. So using this information, which falls into this alternative data space, we can know which company in the Chinese A-share market have investor interest. With that, we can test to see if investor visits do indicate a company that will outperform or not in going forward. So this is an example of using this alternative data, this sea of alternative data for your benefit. Next, let's talk about machine learning. So what is machine learning? Machine learning is really a new paradigm to think about how do you structure input to output, right? In the traditional approach, the way it works is that humans have an idea how the input should be related to output. They program some algorithms, the algorithm reads the input, processes them, converts them into output. So it's really human driven, right? And under the new machine learning paradigm, what you do is you tell the machine, okay, we have this input and we have this output. Now you figure out the relationship between them. And the relationship that you figured out, maybe we can use as a program to use going forward. So rather than human being the driving seat, human are kind of setting up the problem and then take a back seat to the algorithm, letting the algorithm figure out the relationship. So that is what the machine learning paradigm is. The beauty of machine learning paradigm is that, first of all, it's data driven. You can process a huge amount of data. We just mentioned that there's an ocean of data coming at you, right? Well, this ocean of data is really suited for machine learning. It can detect high order dynamics. What do I mean by that is it can detect nonlinear, so polynomial or exponential dynamics. So if something grows polynomially, machine learning algorithm can detect that. It can even detect interaction effect. What do I mean by interaction effect? Interaction effect is when you have a variable A and variable B. When they're separate, they have their own behavior. But when they are combined, the behavior changes of the joint behavior. And that kind of interaction effect actually happens quite a lot in finance. Machine learning can detect that. That's a very powerful thing. Because humans are not really good at thinking nonlinearly and thinking about interaction effects. So the fact that machine learning can detect these patterns are very useful. And again, it's also very flexible, right? So machine learning, if you structure it right, it can prevent look-ahead bias, which is one of the big curses of quantitative investing. as human investors, we all have biases. For example, it is very hard for me to unlearn the fact that during 2008, the global financial crisis, right? A lot of financial stock, really got hurt. But with machine learning algorithm, you can actually explicitly keep that information out when you set up the program, so to prevent look-ahead bias. So it's very powerful. And here's an example of an effect that we discovered during machine learning. You might have noticed reversal effect, right? Which is if a stock has moved down a lot, it will likely go up quite a bit, in the next period. Or if it's gone up a lot, it will likely fall down a lot. It'll go down a lot in the next period. This reversal, and reversal is one of the most well-known effects to financial investors. But by throwing reversal into our machine learning algorithm, we detected additional dynamic on top of reversal. What we have found is that reversals tend not to happen if price movements are accompanied by high news volume. What do I mean by that is that if a stock has moved up a lot, but at the same time there's also a lot of reportings about that given company, right? It will very likely be the case that the stock stays elevated or do not revert as much. Similarly for stock that goes down. Obviously, if you think about it, right, it makes a lot of sense. If a stock goes up and there's a lot of news article being generated, it might mean that the stock movement is really driven by fundamental information, right? Something new that came out that that reevaluates the stock price. On the other hand, when the stock is trading without a lot of accompanying news, it could be trading in an information vacuum caused by people who really wants to push up the price for one reason or another, right? And because the price is dislocated from the equilibrium price, it will likely come down. So this makes a lot of sense. And obviously, if you explain it like that, it's intuitive. But now imagine if you have thousands and thousands of variables. You want to find how they interact to each other. 1,000 by 1,000 is 1 million. It is impossible, well, it's very difficult at least, for humans to literally look at a million combination, right? So this is where machine learning can come in and help us detect these relationships that are somewhat difficult for humans to detect. Yeah, so here's this slide just to show you that, again, machine learning can uncover insights beyond simple linear models. It can spot interactions, and it allows quants like myself to detect relationships that are previously not captured or not known, thereby adding additional alpha on top of our existing model. Finally, I want to talk to you about natural language processing. So natural language processing, as mentioned earlier, deals with human text, not just written text, but actually spoken text. And finance obviously it's a system comprised of humans. You have broker reports, you have news, you have company transcripts all the time, right? So it would be nice if we can process it somehow, and natural language processing allows us to do that. So how do you do natural language processing? Well, there are actually some few very basic steps. First of all, you got to clean your data. A lot of what we can do is really not limited by the algorithm. It's really limited by the availability of data itself, right? So as long as the first order is you have to get the data, make sure they're clean. And then the next thing you do is you what's called tokenize the data. So you chop this data up into smaller fragments. The reason you want to do that is that so now these smaller pieces can be read by computer algorithms. So then convert them into mathematical objects that computers can manipulate. And then once you tokenize it, you can apply it to different applications. One application is sentiment, which some of you might or might not know. Actually, it's the first application in finance for natural language processing is to detect whether somebody, whatever they said, is it a happy thought or is it a upset thought, right? So you can read conference call transcript to see if the company's executives are bullish or they relatively bearish, right? Or you can, for example, another application is you can look at whether the company's employees are very positive about a given company or very negative about a given company. And we typically found that, as you would expect, companies that are positive about the company tends to do better over a long horizon, right? Not only do their stock do better, but you can look at other evidence. For example, companies with more positive employees tend to be more productive, as we have shown in this chart here. Obviously, this is something that company executives know about, right? So know the fact that the quants like us are actually looking at what they say. So they've been changing their behavior over time too. So this chart here shows you the average CEO sentiment on a 3-year rolling basis over the last 15, 16 years or so. You can see that they've been on a steady trend up, right? So company executives know people like us are looking at their transcript and only want to invest with company that with positive CEOs, so their language are becoming more positive over time. Obviously, for us quants, that represents a problem. So that means we kind of continue to develop new techniques that are more difficult for companies to make it less transparent, right? So one example is to not just look at company executive or even employee comments, but look at what they write about, especially those very strong worded languages. Here's an example, right? In this example here, this is a Glassdoor review from 2018 that says, in this particular review, the employees said the company is very creative with finances. Now, that sounds really bad, right? Creative and finance are typically two words you don't really want to see next to each other, right? So we came up with a program to see, can we find employee reviews with these sort of next level unhappiness? For example, this company is breaking the law, or these people are frauds. That's not your usual gripe, right? That's the next level of accusation. And it turns out that companies with these kind of sentiments being expressed about them have 3 times higher likelihood of a blow up 12 to 24 months after this sentence has appeared. For this particular company, it turns out to be Wirecard, which all of you guys know that in 2019 had a big scandal and blew up. Another way to prevent people from hiding their true sentiment is look at not just what they write, but how what they write down, but how they say they think, say it how they feel, right? It's one thing to say the right word. It's a little bit more difficult to actually pretend you're happy and act like it, right? And I'll play a clip for you as an example here. I don't know how many languages you speak. I don't speak that many, but a lot of times, even when I come across a language that I don't speak, I can sometimes tell whether it's a happy conversation or an unhappy conversation, right? So here's a clip that I want to show you, and I want you to tell me whether you think the mom here is happy or not.
Let's see mom's reaction on my haircut. Let's see what she says.
Ma perché?
Che cosa, ma?
Non mi piace. Ma perché ti fai queste capite che c'hai capito? Perché non ti godi capito?
Perché non ti piacciono?
No.
Ah,
No. No, non mi piace.
So most of you would have guessed that the mom in that video is not impressed with the son's haircut, right? I don't speak Italian, but I actually confirmed with an Italian-speaking colleague of mine, and that is indeed the case. Mom is not impressed. Now, why did I show you that clip? Well, I want to illustrate a point. Basically, sometimes even if you don't understand the words being spoken, you know what they're talking about. In fact, there's a 738-55 rule of communication that says only 7% of communication is in the words that's being spoken. 38% is actually in how it's spoken. A full 55% are the body language, facial expressions, etc. So up to now, right, NLP has only been on textual analysis, analyzing what's being written down in text. So NLP has been focusing on only 7% of the communication. Now, wouldn't it be great if we can extend beyond the 7%, go analyze the rest of the 93% of the communication? Well, in my team last year, we did a pilot project that turned out to be a success, where we are able to convert audio signals from conference calls, again, this time not transcript, but actual literal audio clips, and convert them into machine readable objects and conduct analysis on them. So now I'm going to play you 2 audio clips, and after which we're going to run a poll and you will let us know in this poll which one do you think is more excited between the 2 executives, which I will play the clip for you now. Here's the first clip.
I would just say that certainly already having the right-of-way and the infrastructure in the areas. You know, in a lot of our OVM area, we have a loop system, so we have one line that we can.
And here's the second clip.
All right, Ben, let me tackle the first one. Look, you know we don't give guidance, so here's what I will tell you. I will tell you that there are more buyers in the marketplace for hit content than there have ever been in the past. So the way we look at...
Now, take your time, think. If you could only choose between these two companies, based on what you heard from these two executives, not on their word, but on their tone only, who would you invest with? If you have chosen executive 2 or company 2, you would have been right. Company 2 shows more excitement because the way executives spoke, the speech is a bit more faster paced, right? In general, we found that faster pace, higher pitch tends to show more excitement and tends to mean that executive have some hidden information about how future company results are likely to be positive. For your information, company 2 was Paramount Global. It was during April 2016's earnings call, and that was when streaming platforms are really taking off. Paramount, obviously, CBS has a lot of streaming content, and their stock has done tremendously well for about a year after this clip. And the first company is an oil production company, and in the mid 2000s, from 2015 and the mid 2010s, the oil energy prices was in a pretty tough shape. So those are the two clips. Obviously, this is a very obvious example, right? But there are actually higher order information that's containing audio that we're able to extract that were previously impossible without using these techniques. So I'd like to basically conclude. Going back to the question that I asked beginning, is machines going to take over? And according to this Copilot program, which is the Microsoft equivalent of ChatGPT, it says that machine will actually help you a lot, but at the end of the day, you still need human involvement. I hope from my speech today, you can see that yes, machine actually are able to help you a lot, able to answer questions or using techniques that were not possible before. But at the end of the day, it is still driven by fundamental human intuition, right? It is still the human mind and creativity and judgment that really makes the ultimate investment call. But what machine does, though, is it extends our capabilities so much more.